Good evening. My name is Peter Resnichek from ShadowTrader.net, and this is another edition of the ShadowTrader Video Weekly for Sunday, June 27th, 2021. Points to ponder. We've got a lot of them in this video. There is a lot of nuance under the hood that I feel that you're just not seeing out there. You're definitely not getting it from traditional financial media. And these particular weekly videos, I think, are some of the only places in the world that you can get this information. So I do hope that you pay attention. But before I get into the details of what I think is going to happen next week and how we should play it, let's just take a quick rewind into last week. If you recall, the title of the video was, Did Someone Say Taper? Because there was a Fed meeting and there was some talk, at least, that we were starting to think about, or I should say starting to think about talking about potential tapering of bond purchases, right? The Fed always couches it in this sort of nebulous language because they never really want to come out and say exactly what they're thinking in order not to spook the markets. But they did come out and say something to that effect. The market was a little bit weaker, but it really only lasted about a day and a half in typical bull market fashion. And since then, we've gone a bit higher. But within the rally that has just happened, basically this entire week that has just transpired, we've been kind of moving in one direction. There's a lot of nuance under the hood, especially in the market profile, which I'm going to show you, that is pointing to the potential for a liquidation break. And if you're not familiar with what a liquidation break is essentially a fast, quick break in the markets where prices come lower, usually caused by momentum traders that have piled in long at the wrong time. You can think of it as the last in, first out sort of phenomenon. So I'm going to show you some nuance in this video about why I feel that there is at least potential for liquidation break, but at the same time, we're going to kind of play both sides of the coin. I'm going to show you what I think needs to happen in the markets next week in order for the market to sustain and move higher, basically a couple of sectors that I'm looking at. And then most importantly, I'm going to wrap up the video by showing you the exact key levels in the market, where it would go if we were to have such a liquidation break, and more importantly, exactly what you need to be paying attention to so that you will know whether or not any selling that might develop in the market next week is indeed A, just a liquidation break, or B, something stronger, which will bring the market somewhat lower. This is probably one of the most common questions that I get in running my advisory and doing these videos, etc. Peter, how do you know when it's just a liquidation break, or how do you know if it's stronger sellers? So next week it's going to be pretty easy because we've got so many key levels that are so important, and all we're going to have to do is watch how the market acts at these specific key levels. I'm going to tell you all of that in this video. All right, without further ado, let's get into it. So I'm going to start it on the SPY here instead of the SPX, and we're just going to look at this last week here. Obviously, this is the situation here on the FOMC, which turned out to be kind of a nothing burger and did actually go right to the trend line, which is noteworthy, that the support came in kind of right where it should have, even though it closed on a very bearish candle there after a gap down, kind of a gap and go, which is hard to buy. I'll be honest with you. You don't want to really be long that into the close when you've got that sort of bearish action behind you. But after that, we took the whole move back and then staged this rally here, which is the 5 days in question of the past week. But what I really want to focus on, really specifically, are these 3 days, because of the sheer tightness of the range and how small they are, and they're just kind of little gaps and holds, and I think that's really important. And the reason I'm bringing these up, and when I get deeper into the market profile, that'll show you the time and price and volume dynamics behind these bars, right? You'll see that it's evident why I'm talking about this specifically, and the main reason is because we are making new all-time highs. I talked about this with my subscribers earlier in the week, in that if you have situations of poor structure, and we're going to talk about the structure on these up days as well, not just on these days. It's really all 5 of these days of the week that are noteworthy. And again, you'll see it very clearly in the profile. But when we talk about things like deficiency in structure, such as single prints or double distributions or very squat profiles, which are not really deficient, but they're noteworthy because they just tell us that the market's balancing, or very, very wide points of control. These things matter much, much more when the market is in rally mode, and even more important when the market is making new all-time highs. So for instance, for the market to make a new all-time high on that tight candle, with that very small distribution in the profile, that is noteworthy to me. So we're going to talk about all of that. Before we get into that, let's just take a quick look at the other majors, just so you have an idea of where we are. QQQ looks pretty much fine here. Let me just close that off so you see everything. There we go. Similar chart, IWM. I'm just using all the ETFs today. This one is going to be interesting next week to see if it can indeed break out over the resistance here. You see we've tested almost to here, and now we're back there again. And the Dow is actually in my sights. I rarely talk about the Dow in these videos, and I don't trade it that much, but I did a DIA trade on this DIA ETF with my weekly options advisory subscribers just late in the week, Thursday to Friday. We did like a one-day trade, put it on late Thursday afternoon and close it into Friday morning. We were actually looking for a move into the 347 area, which is right up here. We didn't get all the way there, but we got high enough into it that we were able to close the spreads for a nice gain, so that was cool. But this also could be in play next week, because obviously it's just a hop, skip, and a jump to get to that downtrend line, and then maybe prices want to rise higher from there. This sort of W pattern underneath this downtrend line, just so you know, is bullish. It is definitely bullish. So we're either going to hit it and go, which will be a tough buy because of what I call the coming up from the bottom phenomena, meaning that you've already come up from the bottom a long way, and you generally don't want to be buying that type of breakout, or we will touch and pull back, and then there will be different levels at a fib or whatever that could be buyable. If you don't buy the pullback, then you'll wait for the next test on the Dow, and that's the one to go with. That's the one that you probably would buy if you are a breakout and not a pullback buyer. Okay, now let's get into the real nitty-gritty, so to speak, of this particular video, because I want to show you what the market profile is doing over the 5 days in question, which obviously would be these here, while this market has been rallying. So in order to do that properly, let's go back to the beginning here. Now let's talk about these sessions here where we bottomed out. So this one is the start of the rally here on 621. So basically what I'm going to do is I'm going to point out all of the structure that I'm seeing. And you are then going to hopefully write all this down and carry it forward in your narrative. If you're a subscriber to my Peter's pre-market perspective, you don't have to do that, because I write up the narrative every morning, and we sort of add data points to our narrative as we go. Note the single prints. So this is common in a very emotional type of rally where there's a lot of short covering. So basically what you would glean from this is that the market at this moment, when these single prints happened, was basically thumbing its nose at any notion that there would be a taper tantrum in the market due to the Fed comments. Obviously this downdraft here, this downswing, was due to what the Fed was telling us, but the market basically showed that it didn't care, and it's proving it by these single prints. You can see that the profile is extremely thin all up through here, and that thin profile just basically means that stops are getting hit on the upside, and there are tons of people just throwing market orders at the market in order to cover positions, and maybe some of them are even getting long, although usually it's just short covering. I always maintain there are not a lot of smart people at the extremes of markets. The bigger players are generally more active in the middle. More power to you if you can be active at the tails, but generally it's not a lot of people active that way. So that is June 21st, and you can see then we balance off some of that near the highs, and the next day, let me just make sure I have everything right. Okay, the next day we have a similar situation in terms of structure when we put on another rally, but again, notice all the single prints in the rally here. So it's more than just a double distribution. It's more like 1, 2, 3, 4, it's actually 5 distributions, because there's single prints here as well. How do we put this into our narrative? What do we glean from this? It's essentially weak structure. A stronger market that is more sustainable would not do this, so it tells you that there's still some emotion in this market, okay? So carry that forward. Now here's where things get interesting. Then we put in a balancing day here, which would be Wednesday, and we have a very prominent point of control. Prominent point of control is essentially a very wide part of the profile where the most time was spent or volume that day. In this case, it was the same. You can see where it's highlighted in green. That's the most volume that traded during that Wednesday session, and where the profile is the widest is obviously the point where the most time was spent. Now, these wide points of control have higher odds of being tested because we all know that basically that's how markets work. Markets expand and contract from areas of high volume where prices are fair to areas of low volume. They have price exploration where they push away from high volume areas and they try to explore and recreate value in a new spot. And very often before they do so, they will sort of pull in to sort of tag up and retest those high volume areas. Wherever you have high volume nodes on your chart, and you can see this clearly from like a market profile, composite profile, you know where these high volume areas are, and the markets tend to pull back to those areas. So the fact that we didn't is a feather in the cap for the bulls, but it is also what I mean when I said in the introduction that I think there is potential for a liquidation break next week. Because note, the prominent POC on Wednesday never got tested. And then the next day on Thursday, what did we do? We made another one. So we have two very prominent POCs, and Friday's action, notice it made an RTH low here. It didn't test this prominent POC again. So you have two sessions back to back where the prominent POC was not tested, and on top of it, you left a gap in its wake. You have an unfilled gap. So these three things to me are very, very important, that you've got two prominent POCs, which are now VPOCs, virgin points of control, but they are very wide virgin points of control and they have not been tested. So I want you to carry that forward in the narrative next week. And when you put all this together, not to mention on top of that, we did have an excess high on Friday, a little bit, not major, but we need only about 2 ticks to have an excess high. So we had a little bit of what we could call excess here, meaning that the auction, for all intents and purposes, even though it's not big excess, it did end properly. And we have a point of control here, again, relatively wide, not as wide as the prior 2 days on Friday, but a point of control in the middle of the range when prices closed a bit higher and made a new all-time high. And again, this is important. I alluded to this earlier in the video, is that I feel that when the market is making new all-time highs, there should be an expansion of range as those higher prices attract more buyers. But all we saw in this market was really just a lot of chop, and we seem to be grinding higher. And that's why I'm saying there is at least potential for a liquidation break next week. Now, what will the market do if there is a liquidation break, and where will it go? Well, first of all, what you should be targeting is at the very least the two POCs, the prominent POCs. The first one is at 42.5625, and you can write that down if you like. That will more than likely be important, and I'll make it a bit smaller. And the other one is right here at 42.39. So keep that in mind. If there is a liquidation break next week, the market could sell off hot and heavy very quickly and test all these areas at once. Jim Dalton calls that the firecracker effect, because these are areas where there will be stops below those areas, especially the bottom of this gap. If the gap gets filled and goes below, there's probably some stops there. But very often in a liquidation break, what happens, and this is basically the nature of how liquidation breaks work, is they will have much faster tempo than what you've been seeing before. If you've been watching the market closely over these days, especially the past 3 days, you will have noticed that the tempo in the market was extremely slow. It was practically glacial. It was just like so slow. Market was just kind of going sideways, and the tempo was very slow. The tempo is obviously nothing more than the speed of the tape. When and if a liquidation break occurs, the liquidation break will be on much faster tempo, so you'll know that right away that it's a potential liquidation break happening, because things will be happening faster. And liquidation breaks often take out multiple pieces of poor structure or market profile dynamics in one fell swoop, meaning it will tag the prominent POC here, fill the gap, and tag this prominent POC all in one move. And believe it or not, that can happen in like a half hour, couple hours, whatever it takes. This can happen. This is very, very typical of how a liquidation break works. So now, how will you know if it's just a liquidation break or if the market is actually going to fall further? That's actually not that difficult to tell, and I'm going to tell you exactly how. You're going to basically use the exact same levels that we just talked about, and you're going to see how the market reacts at those levels or if it turns. For instance, let me give you a couple of scenarios of how things could play out next week if it is indeed just a liquidation break, and let's just say, for the first example, a very benign liquidation break. Okay, what that would do is more than likely come down to the prominent POC, tag it, and turn almost on a dime and start to go back up. Or come, for instance, to the top of the gap, break into the gap a little bit, and start to move up, failing to fill the gap. That's a signal, right? Why? Because all of this structure in the profile is telling us what the market should do. So we've got all these great clues and all this fantastic market generated information to know what the market should do if it starts to sell off. So you will know that it's nothing but a liquidation break or a very benign liquidation break if you come down to certain levels and turn right away, or even more importantly, fail to make certain levels that you know the market should do. Like, for instance, like I just said, coming into the gap and not filling it. Or how about this for another scenario? Filling the gap and bouncing, or filling the gap, for instance, and coming to right here. I've seen this happen all the time. And then just turning around and going back up hard off to the races. Well, again, tells you that it's obviously a classic liquidation break because you didn't even make it to the lower POC where you should have went, and that's important. So these are the things you want to be thinking about next week in terms of the key levels. Write down the key levels, look at the prominent POCs, look at the gap that is just below us. Okay, and then watch the market and see basically how it acts. If there is more momentum to the downside, you probably would be putting these single prints into play at 4202. The tops of areas where emotion ended, let's say, for lack of a better word. This is like emotional short covering up to here, and then it was just more balanced than where the emotion ended, so to speak. Those are often support points. So a very large liquidation break could potentially take the market all the way down to that area. I'm just putting that out there basically as a ultimate target, let's say, if this was to happen. Now, all this that I just talked about is obviously a big if. Remember, it's just very, very important to have a game plan when you go into the markets, and very, very important to have different scenarios in mind and all of the context that would support those scenarios before they happen, so that you are not beholden, or a victim, I should say, that's better said, a victim of what I like to call shock and awe, meaning that you are in shock and awe that the market's actually gapping down on Monday or going down hot and heavy, and then what do? You sell your longs, or you enter into short positions prematurely and you get hurt. That's what I'm trying to get you away from, so that you don't make those types of decisions. So as I said in the intro, let's look at the other side of the coin as to what the market needs to do next week actually to go higher. One of the keys, I think, to going higher is going to be in two sectors. Actually three if we talk about tech, because tech is such a huge proponent of the S&P. So always, or component I should say, of the S&P. But I want you to watch industrials and financials next week. Let's start with financials here. They just broke trend, and that's really bullish here. So that's important to note. There's potential for a move here to the prior high here. So watch these financials because they're worth about 10% of the S&P. And if we can get a candle going up above that trend line, we start to find acceptance and we don't fall back below, that's going to be a good sign, which will hold the S&P higher. Another one, as I said, I'm looking at is industrials. They've been kind of strong as well, although Friday wasn't the best close, kind of went up high and backed off. They've got a key resistance here. And as you know, we're in the middle of the discussions on the infrastructure package. I think infrastructure package moving forward pushes these stocks higher. So you want to be looking at Caterpillar, John Deere, et cetera, all these XLI stocks. I think a close over these two key moving averages in the XLI would be important and would open the door to higher. And if we can get that, then obviously the S&P would be just fine. So these are some of the things also that you would want to be watching if indeed we get a liquidation break. Watch how some of these sectors act. And of course, as always, even though it's mostly we think of it as the NASDAQ 100, but remember that tech is almost 30% of the S&P 500, XLK. see how this acts. We do have some overextension from the 20-period moving average. So again, any sort of liquidation break, where does it go? Just like I was telling you about those nuances in the profile to be looking at, do we test those POCs? Do we test that gap? Do we get below that gap, et cetera, et cetera? Watch your XLK next week, because if there is any sort of a break, how far down does it go? An XLK that barely sells off is very, very bullish. We've been seeing this type of divergence in the markets for a while now where, if there's a break, it's going to happen in all markets. But what you want to be watching for is how strong of a break it happens in all markets. So let's just say, again, I like to put out scenarios. They're the best way to think about the markets. Think in terms of what if, think in terms of potentials. ES breaks down big next week, but you're looking at your market minder window and you see that ES is down, say 0.75% on that liquidation break, but at the same time, the NQ, as the ES is selling off liquidation break, the NQ is down 15 basis, less than a quarter of 1%. Very, very important. Now this gives you lots of market generating information to go on. Maybe makes you even think, aha, I'm actually going to buy this ES break as we come into that POC, or I'm going to buy it at the top of that gap or the bottom of that gap or wherever we are, because I'm seeing that strength in the NQs, and I know that that's basically not how markets work. It'll be much more difficult for the ES to keep moving lower and break through those support points if that NDX is holding up strong. And last but not least, I want to leave you with one last scenario and the implications of that scenario, because obviously coming into the weekend and just in general, nobody really knows what the market is going to do on any particular day, right? There could be news over the weekend, there could be whatever. But let's just say that the market gaps up actually, or opens flat on Monday and actually goes higher, and then creates a large expansion of range, a very healthy candle to the upside that might look something like this. Obviously that would be just fine. We're generally long the market now. There's really nothing short out there to speak of, so that would be just fine. But here's what I want you to remember. If that is to happen, okay, make sure that you pay close attention to what's going on in the market profile. And I'll just bring this back one moment if I could, since I took it away. Pay close attention to what happens in the market profile, and remember that everything that we talked about in this video in terms of the structural deficiency and the wide points of control and all of that should be carried forward. It doesn't change any of that structure beneath us. And the way you look at that stuff is you just keep adding it onto your narrative. And if we have that sort of a situation in the market where we actually go higher early next week, just remember, continue carrying forward those virgin points of control, prominent points of control, gap, etc., because they're still there, and at some point they will more than likely come into play. And that's all for this week. Thank you as always for spending just a little bit of your weekend with me. So I do hope sincerely that I've left you with some very salient information on how you should approach this market next week, what you're going to need to look for the market to go higher, potential for a liquidation break, all of the key levels that I believe you should have written down to make sure that you know what key levels are going to be tested if the market breaks. And of course, watch very closely to see how they act at those levels, which will tell us if it's something bigger than a liquidation break or just kind of status quo and the market's just taking a little bit of the froth off. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.